First lien bonds is the main subject of this video. I have discussed this topic in two prior videos, which I will link in the more section below. I have been gravitating to buying more first lien bonds, possibly due to experiencing more unease about what is happening in Washington, which may soon include a broad-based tariff war started by President Trump. As reflected in the current major stock index levels, bond yields, and the break-even inflation rate for the 5-year tip, stock and bond investors do not believe that Trump will start a trade war, or if he does, it will not last for long. The probability, in my opinion, is zero or close to zero based on those prices. I would place the odds of a long-duration trade war, broad-based, at a much higher probability than nil. More probable than not would be my best guess at the moment. Before starting that discussion, I would just note that the 6-month Treasury bill auction today, February 18th, 2025, resulted in a 4.372% investment rate with a maturity on August 21st, 2025. The current federal funds range is 4.25 to 4.5%, so this investment rate for the 6-month bill is above the midpoint of the current range and is consequently, in my opinion, inconsistent with a Fed rate cut on or before the July meeting. I participated in the 6-month 1-year T-bill auction today and the 1-year T-bill auction. I bought the 1-year Treasury bill as part of a normal shifting of income into the next calendar year, which will be 2026, by holding that 1-year T-bill to maturity. The interest income will be taxed in 2026. I bought two Sabine Pass liquefaction 4.2% first lien bonds today that mature on March 15, 2028. My total cost was $98.02, creating a yield to maturity of 4.9% for that first lien bond. The secured bond is rated at Baa1 BBB+. I view a rating below A- for a secured bond as indicating more credit risk than reflected in what one would normally associate with a first lien bond. Sabine Pass is a private company that owns a huge natural gas liquefaction and export facility in the Cameron Parish of Louisiana at the Sabine Pass. It is an indirect, wholly owned subsidiary of CQP, a publicly traded limited partnership. I replaced one Sabine Pass liquefaction 5.625% bond. That is also first lien that will mature on March 1st, 2025. This is a common practice for me. I bought two of those bonds, and one was called early at par value last December, as I recall. When I bought that bond at below par value in April 2024, the rating was Baa2 BBB+. So Moody had upgraded the bond by one notch since I bought those two bonds back in April 2024. Part of the bond investment process is reviewing the prospectus and at a minimum the last earnings report. I needed to confirm that this was a first lien bond and the whatever exceptions that there may be to the first lien. The last earnings report is available at the SEC, and it was for the quarter ending September 30, 2024. Net income was reported at $648 million, with revenues at $2.005 billion. I view this bond as relatively safe, provided no major disaster strikes and destroys all or a substantial part of this facility. Disasters could include, for example, a hurricane or a major fire engulfing the facility. I will not own more than two, except for a brief period, which is the case with this last purchase. The last bond I own will mature in a few days. That I owned prior to this last purchase. The bond was initially sold in a private offering and became publicly tradable upon the filing of a prospectus on June 19th, 2017. You can find that at the SEC website. Just to enter Sabine and then look for Sabine Pass Liquefaction LLC, and you'll find it. The first lien is broad and is described at page 11 of that prospectus. The lien attaches to substantially all assets, including real property, contracts, cash flow, and other revenues. Most of my buys today in bonds were senior unsecured bonds maturing in 2028, where I've been concentrating my corporate bond buying as of late. There are two reasons for that. I have only started to fill up that year in my bond ladder, and the yields are slightly higher than what similarly rated bonds maturing in 2027 pay. The bond ladder is a way to address what I consider to be unknowable, and that is the future course of interest rates. Given the relatively short duration of my bond ladder, I am consequently better situated for a rise in interest rates rather than a long-term secular decline in them. By moving more purchases into 2028, I at least partially respond to the possible scenario that rates will decline and the Fed will, at some point within a few years, restart its jihad against the savers through a resumption of ZIRP and QE, which are in practical effect, in my opinion, a confiscation of income that would be earned without interest rate suppression. I didn't vote for that. There are first liens that would be rated junk if they were rated at all, and most are not. I'm referring to mostly leveraged loans owned by BDCs and certain funds. The first lien of a leveraged loan may attach to nothing but air, as proven many times when a highly leveraged private company files for bankruptcy. You might ask how a first lien becomes worthless, and the answer is simply there was no there to begin with. On the higher end of publicly traded first lien bonds are those that are issued by operating electric and gas utilities that are wholly owned by utility holding companies that are publicly traded. The operating companies are not publicly traded. Their first mortgage bonds are. If you did a bond search with the keyword energy, ENTERGY, that's a large, very large public utility holding company, you will see some bonds issued by the holding company and then an array of bonds issued by the various operating subsidiaries of energy. And those are first lien bonds and have higher credit ratings than the holding company debt, which is unsecured. Operating subsidiaries of other utility holding companies issue first mortgage bonds, and that is actually common. Once you delve into this area, you will find a significant number of them. I discussed one issued by the Public Service of Colorado in a recent blog post, and that is a wholly owned operating subsidiary of the energy holding company, the electric utility holding company, XCEL Energy. Some mortgage bonds issued by those subsidiaries are traded on the stock exchange and trade just like a stock. And I'm referring there to subsidiaries of Energy, which would be Energy Mississippi, Energy Arkansas, Energy Mississippi, Energy Louisiana, if I didn't mention it. Those are currently selling at discounts to par value. I own several, but am hesitant to have much of an exposure to them, even with a current yield near 5.75%, which is where they're close to where they're trading now when I last looked earlier today. And the reason for my hesitation in owning much is that the maturity dates are in 2066. My hope in buying them is that I can liquidate the positions profitably as I've done in the past when and if the Fed starts another rate suppression regime and takes the long-term bond yields below 3%, whereupon the issuers of these bonds might call at the $25 par value, where I would realize somewhere between $3 and $4 profit per share, depending on my average cost per share for each one that I own, which varies from account to account. I own those in 3 taxable accounts and probably in at least one or both Roth IRA accounts. I have discussed buying the $1,000 par value first mortgage bonds issued by these energy subsidiaries in my blog post, and other first mortgage bonds as well issued by other operating companies. And those purchases mature starting this year into 2028. I don't think I had a single one until today that matured beyond 2028. That short duration removes a lot of the interest rate risk of the exchange traded bonds, which are substantial. Just think of what would happen if a 30-year Treasury bond went to 10%, and what would happen. They would be selling for less than probably in the high single digits if the if the 30-year Treasury bond went to 10%. And don't think that is impossible. In my lifetime, it was over 15%, and that was in the early 80s. The Energy Mississippi has a $25 par value exchange traded bond that has the symbol EMP that I own and have discussed many times in my blog post. The security trades like a stock on the stock exchange. The coupon is 4.9%, paid on a $25 par value. That one is trading below 22 right now. The issuer has an optional right to call at par value. If not called, the bond matures in 2066, which is the main problem with it. Interest is paid quarterly. Whoever owns the security on the ex-interest date receives the entire quarterly payment. No accrued interest is paid to the settler. Unlike when you trade in the bond market and buy a $1,000 par value bond, you have to pay the accrued interest to the seller. And when you buy the exchange traded bond, you don't have to do that. This is what's called trading flat. Today, for the first time, I went further out than 2028 with a $1,000 par value purchase. I bought just one Energy Mississippi 5% first mortgage bond maturing on September 1st, 2033 at a total cost of $98.794, creating a yield to maturity as of today at that price of 5.176%. The current yield of that bond is significantly below the yield of EMP, the exchange traded first mortgage bond issued by the same company. But the interest rate risk is substantially less with a maturity 8+ years from now compared to one close to 41 years. I limited the risk by buying just one now and possibly would buy more down the road closer to maturity when and if the price declines below where I bought this first one. That's pretty much how I limit, one of the ways I limit risk in bond buying.